want to take a few minutes to share our initial thinking on the conflict that has erupted in the Middle East over the past several days. This is a serious and fast-moving situation, and anyone who tells you with certainty exactly how it will unfold is overconfident. What we can do is share the lenses through which we look at this conflict, lay out the risks that we see as realistic, and explain how we're thinking about managing our investment strategies. Late last week, the United States and Israel launched coordinated military strikes against Iran, targeting its nuclear program, its missile infrastructure, and its military command structure. Iran has retaliated with missile and drone attacks across the region. The Strait of Hormuz, through which roughly 20% of the world's oil travels, has been severely disrupted. Oil prices have risen sharply, and global equity markets have been volatile. We believe that what is happening in the Middle East is not simply a regional conflict, and that investors who think of it that way may be missing the forest for the trees. The forest, in this case, is the ongoing competition between the United States and China for economic influence, technological leadership, and geopolitical primacy. We believe how this conflict resolves may have longer-term implications that extend beyond the Middle East. First, we believe history is on the side of patience. Historically, markets have consistently overreacted to geopolitical shocks in the near term and recovered as clarity has emerged. And we believe that pattern may reward investors who stay disciplined. Second, at this stage, our sense is that this conflict is likely to be measured in days and weeks, not in months or years. Iran's leadership has been severely disrupted. Its economy was already fragile, and we think that there are multiple actors with strong incentives to bring this to a close. In our base case, oil prices stabilize, the strait gradually reopens, and the global economy absorbs the near-term inflation impact without tipping into recession. The first risk to our base case is recession. We think a prolonged conflict, keeping energy markets disrupted for months rather than days, could put sustained upward pressure on inflation, complicate the Federal Reserve and other global central banks' ability to cut interest rates, and weigh on economic growth. The historical evidence that markets recover after geopolitical shocks holds except when those shocks trigger a recession. The second risk to the base case is broader regional escalation, drawing in additional actors. A tail risk we view as unlikely, but worth naming. We believe this could further disrupt global trade routes and supply chains, and could require a more significant reassessment of portfolio positioning. Many of our clients have heard us use the term capital friendliness to describe a country's ability to attract global investment. We believe that if the Iranian regime is removed from the board or fundamentally transformed, the unlocking of investment across the region could be profound. We believe that a more stable Middle East could represent one of the most significant emerging market opportunities of the next decade.